Most people who hold XRP, XLM, or HBAR right now are watching the wrong screen. They are staring at a price chart, arguing about market cap comparisons, debating which project has the best white paper. And while that debate is happening in every Discord server and comment section on the internet, one of the most significant macro shifts in 30 years is unfolding on the other side of the world. And it has the potential to make every single chart argument completely irrelevant. That shift is happening in Japan. And once you understand what it actually means, you will never look at XRP, XLM, or HBAR the same way again. Here is what most people do not realize. For over 3 decades, Japan kept interest rates at or near 0%. Borrowing yen was essentially free money. And global institutions, banks, hedge funds, sovereign wealth funds, all of them discovered a trade so profitable it became the backbone of global liquidity. It was called the carry trade. You borrow yen at 0%, convert it into dollars, invest those dollars into higher-yielding assets anywhere in the world, and you keep the difference. Bonds, U.S. tech stocks, emerging markets, Bitcoin during risk-on periods. All of it. The carry trade pumped liquidity into global markets for decades. Estimates put the total size of yen carry trade positions at somewhere around $500 billion. That is $500 billion of borrowed Japanese money flowing into global risk assets, creating artificial demand, inflating valuations, and acting like oxygen for every market that benefited from it. That oxygen supply is now being cut off. Right now, in real time, Japan's 10-year government bond yield has surged to approximately 1.95%, its highest level in 25 years. The 30-year yield is approaching 3.95%. The 40-year yield has risen by 181 basis points since March of 2024. For a country that lived at 0% for 3 decades, those are not just numbers on a screen. Those are a financial earthquake. As the American Enterprise Institute put it directly, the narrowing of the interest rate spread between Japanese bonds and U.S. bonds could lead to an unwinding of the Japanese carry trade and to the repatriation of capital to Japan. And in January of 2026, long-dated Japanese government bond yields surged to record highs once again, intensifying every single concern that analysts had flagged throughout 2025. Here is what the reverse carry trade actually means in plain language. Japanese institutions borrowed yen years ago at near zero cost. They converted that yen into dollars. They invested those dollars into U.S. assets. Now Japanese bonds are paying real yields for the first time in a generation. Those same institutions do not need to be in U.S. markets anymore. They can make money at home, so they start selling U.S. stocks, U.S. tech, U.S. treasuries, Bitcoin, anything liquid enough to convert back quickly. They sell the foreign assets, convert the proceeds back into yen, and return home. When that process happens at scale, it creates what analysts call a sudden liquidity shock. Big market dips, increased volatility across every risk asset class, forced liquidations, selling pressure hitting assets that did nothing fundamentally wrong. The yen carry trade unwind in early August 2024 was a preview. Bitcoin fell sharply, U.S. momentum stocks collapsed in a single session, and the Bank of Japan barely had to move. That was a partial unwind. What is building now is structurally larger. And this is where XRP, XLM, and HBAR stop being just crypto tokens and start being potential solutions to a global financial infrastructure problem. Let us start with XRP because the Japan connection here is not theoretical. It is documented, operational, and expanding right now. SBI Holdings, one of the largest financial institutions in Japan, has owned roughly 9% of Ripple since 2016. SBI Ripple Asia has been running cross-border payment services using the XRP ledger for years. SBI Remit, their international remittance subsidiary, actively uses XRP as a bridge currency for transfers to the Philippines, Vietnam, and Indonesia. And on March 31st of 2026, SBI VC Trade began officially distributing Relust, Ripple's US dollar-backed stablecoin, fulfilling an agreement signed in August of 2025. Japan's finance minister publicly backed blockchain-based security settlement and stablecoin integration in February of 2026. The Bank of Japan launched a blockchain settlement sandbox in March of 2026 to test moving central bank reserve money on-chain. And just days ago, SBI Ripple Asia and South Korean blockchain firm DSRV began joint research on using the XRP ledger for the Japan to Korea remittance corridor specifically. Read that list again slowly. It is not a list of possibilities. It is a list of things that are happening live right now in the country that sits at the epicenter of the biggest macro liquidity event in 30 years. Now here is the part of this story that most crypto content never connects properly. When a liquidity crisis hits, when carry trades unwind, when cross-border settlement stress increases, when FX volatility spikes, what do financial institutions actually need? They need speed. They need settlement certainty. They need tools that reduce FX friction. They need the ability to move money across borders instantly without the 3-day settlement windows and Nostrovostro account nightmares that traditional correspondent banking creates. XRP was literally built for exactly that environment. It settles transactions in 3 to 5 seconds. Fees are a fraction of a cent. On-demand liquidity removes the need for pre-funded accounts sitting idle in foreign currencies. In a liquidity crisis, the tool that moves money fastest and cheapest does not become less valuable. It becomes more valuable. That is not hopium. That is macro logic. Now let us talk about XLM, because Stellar's positioning in this environment is different from XRP's, but equally important to understand. While XRP has dominated the institutional settlement narrative, Stellar has built the deepest infrastructure in the financial inclusion and cross-border remittance space. Franklin Templeton's Benji token, their on-chain U.S. government money fund, holds nearly $500 million on the Stellar network. Amundi, Europe's largest asset manager with over 2 trillion euros under management, launched a tokenized fund on Stellar in March of 2026. PayPal chose Stellar specifically to launch PYUSD in June of 2025 because the network could handle the scale and speed of their payment operations. Société Générale integrated their euro-backed stablecoin onto Stellar for MiCA compliance. CME Group launched XLM futures contracts in February of 2026, the first time a major derivatives exchange created a regulated product around Stellar's native token. And regulators designated XLM as a digital commodity, removing the securities uncertainty that had kept cautious institutional players at a distance. The ISO 20022 standard, which is now in full effect after the coexistence period with legacy SWIFT messaging ended in late 2025, positions both XRP and XLM as bridge assets that can carry the structured financial metadata that the new standard requires. In a world where correspondent banking is being stress-tested by yen carry trade dynamics, by capital repatriation flows, by FX volatility spiking across every major currency pair, Stellar's low-cost, high-throughput infrastructure for cross-border settlement is not a nice-to-have. It is exactly what the system needs. Now let us bring in HBAR because Hedera's positioning in this macro environment operates on a different layer from both XRP and XLM, and it is one that most people completely miss. When capital flows get stressed, when global liquidity tightens, when institutions are navigating simultaneous FX pressure and settlement uncertainty across multiple jurisdictions, the one thing that becomes non-negotiable is trust in the infrastructure itself. Not just speed, not just cost, but the verified certainty that the data flowing through a settlement system has not been manipulated, cannot be altered, and can be audited at any moment by any party with the right access. Hedera's Hashgraph architecture processes over 10,000 transactions per second with deterministic finality, meaning a transaction is final the moment it settles. There are no reversals, no reorganizations, no uncertainty about whether a completed settlement might be rolled back. For institutions managing trillions in cross-border flows during a period of macro stress, that certainty is not a minor feature. It is the entire point. Hedera's governing council includes 31 enterprise members: Google, IBM, Boeing, FedEx, Deutsche Telekom, Standard Bank, McLaren Racing, which joined as a full voting council member in March of 2026. These are not organizations that make multi-million-dollar governance commitments to experimental technology. They made those commitments because Hedera passed the institutional due diligence bar that most crypto projects cannot get near. The network has also been identified alongside XRP and XLM by analysts as one of the 3 core protocols being positioned for the ISO 20022 global liquidity infrastructure build-out, described in research as a potential $43 trillion shakeup in how global finance settles value. Here is the price mechanics explanation that most retail investors never hear. When XRP, XLM, or HBAR are used for real institutional settlement, those tokens do not go back on exchanges. They sit in custodial accounts, liquidity pools, corridor wallets, and settlement infrastructure. The freely traded liquid supply on open markets starts to shrink. When supply shrinks in the presence of sticky, non-emotional institutional demand, the price does not spike and crash like a memecoin pump. It reprices. It finds a new floor that reflects the liquidity role the asset is performing. That is fundamentally different from retail speculation cycles, and it is the difference between a price move that matters and one that eventually reverses. Light corridor adoption by one country like Japan alone, even at a fraction of the FX volume that flows through Japanese institutions daily, creates constant buy pressure, deeper liquidity pools, stabilizing price floors, and upward pressure from settlement demand. Not one country. Japan is the third largest economy in the world and one of the largest FX markets on the planet. If even a meaningful slice of its cross-border settlement activity flows through XRP rails, Stellar rails, or Hedera infrastructure over the next 3 years, the demand dynamic for those tokens changes structurally. Not temporarily, structurally. And here is the final piece of the puzzle that ties everything together. The reverse carry trade does not create a clean, predictable crisis. Natix's chief economist for Asia-Pacific warned that the carry trade unwind coming now will be worse than what markets saw in August of 2024. Other analysts frame it differently, describing not a sudden implosion but a progressive erosion over a long period as confidence in the US dollar weakens and Japanese capital gradually returns home. Either scenario, sudden shock or slow erosion, is an environment where the tools that move money fastest, cheapest, and most reliably across borders become structurally more valuable with every passing quarter. XRP is built for liquidity. XLM is built for access. HBAR is built for institutional trust. 3 different architectures. 3 different positioning strategies. But all 3 sitting precisely at the intersection of the macro problem that Japan's 30-year rate experiment ending has just created. Most people looking at charts right now are asking the wrong question. The right question is not where the price is going next week. The right question is what happens to settlement infrastructure demand when the largest FX market in Asia is going through a generational financial transition and the banks at the center of it are already testing and deploying blockchain rails. That is the question. And for XRP, XLM, and HBAR holders who are paying attention to the macro forces rather than the noise, the answer is already beginning to write itself. If this video helped you see what the charts alone cannot show you, hit the like button right now. That is how this reaches the holders who need it before this story is fully priced in and not after. Subscribe if you want macro-driven analysis like this every time a major shift is developing in global finance. Because 2026 is moving fast and the gap between what macro-aware investors see and what chart watchers see is growing wider by the week. Here is the comment I want from you. Between XRP, XLM, and HBAR, which one do you think benefits most from Japan's 30-year rate cycle ending and why? Drop your reasoning below and let that debate run. And if you know someone holding any of these 3 who thinks the story is just about crypto market cycles, send them this video. Today, the macro picture does not care what the charts say. Stay macro. Stay positioned. Stay ahead of the story.